evening, everybody. I'm now staring at myself, but can everyone see my slides?
We can, yeah.
You can, okay, great. There we go. So I'm going to take you through the interim results for Impax Asset Management Group PLC. So those are the results to the end of March. And in summary, for those of you that don't know us, we are an investment management firm, 25 years old now as of last week, which is focused on a particular investment idea, which is that what we call the transition to a more sustainable economy is an area for investment outperformance for sophisticated investors around the world. And so what we've done for a quarter of a century is assembled a large number of institutional clients, pension funds, sovereign wealth funds, private individuals in four corners of the world who are backing us to make them returns that beat the index. We've got one of the world's largest investment teams dedicated to this area, and we're operating across three asset classes: listed investments, listed equities, fixed income, and private markets. The business idea for shareholders is to scale this business. We're currently managing around $50 billion US, and we believe that with today's product range, broadly speaking, we can manage roughly double that amount. So our plan over the next few years is to move the business in that direction to achieve the economies of scale. So what do we mean by our investment philosophy? Well, it's probably no surprise that on a finite planet, 8 billion people and the rising world population, the pressure that our economic activity is putting on natural resources and environmental resources is leading to the need for constraints. So there's a big switch underway from fossil fuel energy to renewable energy. There's the electrification of the drivetrain as manifest in rapid growth of demand for electric vehicles. There's huge opportunity to deploy money in the infrastructure space, particularly in water, in air quality mitigation, and in new and efficient ways of producing food for a large global population. So without going into too much detail, I'm sure it's intuitively clear that the market growth in many of the areas linked to this transition is very high, and that probably no surprise that many of the companies that are operating in these markets are often misunderstood, misvalued, because the average investor, the market, doesn't appreciate their technological advantage, the policy tailwinds, the strength of their franchise. So our job as investment managers is to build portfolios with the best companies in this area of investment, and it's particularly worthwhile having a dedicated team in this area because it's so complicated, and the average investment manager is quite often struggling to make head or tail of it. So in the 6 months to the end of March, we've produced pretty strong growth, net inflows of £1.1 billion, taking us to just over £39 billion assets under management at the end of April. So markets obviously moving around, but the key thing for this business is that we are continuing to attract capital. Our investment performance remains very good, and we've continued to add to our investment management capabilities as well as our sales and marketing capabilities. It's a quick snapshot of the numbers. So the dark blue bars are relevant for the 6-month period that I'm focusing on. The mid blue is the previous 6 months, and the light blue is the 6 months prior to that, which of course is the corresponding H1 period for the previous financial year. So no need to get into the numbers right now, but if you can see on the left, revenue fairly flat across those 3 6-month periods. That does reflect pretty terrible market conditions last year for equities, but continued positive inflows. Assets under management you can see on the right hand side, and you can see our operating margin on the bottom left, which is on a run rate basis nicely stable from the start of the period to the end of the period. And we've also announced a maintenance of the interim dividend shown in the bottom right, and we do have a progressive dividend policy for a total dividend with the aim of paying between 55% and 80% of our distributable profits out in dividends. So how do the successive 6-month periods look in terms of the progress of our assets under management. So if you look at, again, the dark blue bars where we've ended up, the top half of the page shows how the market moved and our inflows and outflows shaped up for the 6 months to the end of March. And then the bottom half of the page is the corresponding data for the previous 6 months. So you can see that in the last 6-month period, markets have been positive compared to negative for the previous 6 months, and inflows exceeding outflows, and hence the 1.1 billion of net inflows. So the opportunities around this transition to a more sustainable economy continue to strengthen over the last 15, 18 months. Of course, we've had the fallout of the terrible situation in Ukraine, which has caused a big spike in energy prices. But we've also had some strong policy tailwinds for this area through the US Inflation Reduction Act and corresponding policy developments in European Union and China. High energy prices, of course, are very good for energy efficiency oriented businesses, as they are for those in the renewable energy sector who are selling into higher prices than previously. So in that context, in spite of some quite challenging equity market conditions over the last 18 months, then Impax's investment philosophy really has continued to shine through in terms of outperformance, and we continue to be incredibly well positioned. We are, I believe, the leading brand globally in this space, certainly the largest authentic, dedicated investment manager focused exclusively on this area of investing. Our client base is around 100 individual funds and accounts, so we've got around 100 contracts. Underlying those contracts are, in some cases, many thousands of individual investors, but we think of ourselves as focusing on the institutional space with around 100 contracts. In the equity space, which is 95% of our assets under management, we're investing in two types of portfolio: so-called environmental markets, which are thematic ideas around, for example, water or food. Our investment trust, Impax Environmental Markets, which is quoted on the London Stock Exchange, is in this part of the company as well. So that's the majority of our revenues. Since 2015, we've been investing more broadly in equities in what we call sustainability lens, which is less thematic. That's the orange part of the top right pie chart. And that's also, you can see on the top left of the pie chart, been growing recently in terms of market share. The bottom half, you can see, look at the bottom left, a reference there to BNP. That's BNP Paribas Asset Management, which is our largest shareholder, with about 14% of the company's shares. And the percentage of the business that we get from them, because they're also our largest distribution partner, has been dropping slightly. And that's our plan, as we intend to continue to diversify the sources of business away from that single point client. And then crucially, our geographic coverage shown here in terms of clients. On the left-hand side, you can see the UK responsible for about 20% of our assets under management, and therefore 80% of our business is coming from overseas. We have offices in the US, Hong Kong, Ireland, and most recently Tokyo. I don't want to get too bogged down in the details here, conscious of the time available for this presentation, but what this chart shows is the movement of our assets under management in different geographies over the 6 months to the end of March. So 3 columns. The left-hand column shows that the UK, St James's Place, was a nicely positive contribution. That's a bar to the right-hand side of the middle line. In the middle, BNP Paribas also positive, as was other EMEA distributors, where we signed up 2 new accounts with ABN AMRO and Lombard Odier in particular. North America somewhat negative, which I think was reflective of very tricky market conditions for equity management, outflows across most managers in the period in question. And then in Japan, on the bottom right, that's the Asia Pacific dark blue bar. We had a big win with the world's largest pension fund, the GPIF pension fund, who hired us at the start of the period. A couple of busy charts now on investment performance. If you just look at the dark blue bars and compare them to the mid blue bars, the dark blue bars are our investment returns over 1, 3, and 5 years. The mid blue bars are the returns of the corresponding indices, benchmarks, if you like. So the fact that the dark blue bars are bigger than the mid blue bars means that we're beating the index, which we are for a majority of our strategies. The 5 here, so that being the sustainability, lens, equity, and fixed income strategies, and then the corresponding numbers for the 6 thematic strategies shown on this second chart. So these data is all on our website if you'd like to look at that in a little bit more detail. We're also continuing to invest in the development of new products. So during the period, we launched a new listed infrastructure strategy. We are developing for launch later this year a social markets listed equity strategy focused on areas like education, healthcare, and financial inclusion. We're continuing to raise money for our private markets product, which is in its 4th fund vintage. And we are actively pursuing business development opportunities as well in the fixed income space. Our clients really value not only our investment activity, but also our insights in areas around the edges, if you like. So we do a lot of policy analysis work and provide feedback to policymakers about, for example, how markets for electric vehicles could be optimally designed. We do research in areas like biodiversity and physical climate risk. We're active members of many different groups of investors around the world operating in the space. This is increasingly of great value to our clients who want to use Impax not just for great investment returns, but also as their proxy in this complex world of sustainable development. Our stewardship and engagement work, we're active owners of the companies that we invest in, and we gather impact data around the environmental outcomes that our company investments are making and produce reports, which we're sending out on an annual basis, and have done that for the last 10 years. People is right at the heart of the firm. So just a slide here showing how our headcount has grown across the 5 country bases. So we've added people across the organization at a slower rate in this period than we were doing 6 months previously, which reflects the more challenging equity market conditions, but we're still pursuing that doubling of the business objective. I won't talk in any detail about systems and infrastructure, but I just want to reassure you that as the business grows, we're continuing to invest in crucial areas like compliance, information technology to get scale through the business. And we've got a new risk management team looking at corporate risk. I'm just going to skip over the financials, given that I want to be moving to questions fairly quickly. There's quite a lot of detail in these slides, but on the right-hand side of this one, you can see our average fee margin. So this is the basis points that we charge on assets under management, which across the 100 or so accounts on a weighted average basis has dropped very slightly in the 6-month period in question. Again, let's look at the dark blue bar as the most recent data. And you can see their data on the run rate revenues as well. Revenue continues to be very well diversified across those 100 clients and across a very broad range of geographies and client types. So this is a very resilient business in the context of exposure to individual clients, but we are an equity manager, so we do have equity market risk as a sort of systemic factor. Very keen control of operating expenses. So as the business has grown and we're approaching 300 people, then we are paying particular attention to efficiency and ensuring that we're getting the most out of our staff. Some of the data here, for example, the bottom right, assets under management per investment staff member, showing it's a sort of key metric of efficiency. And some data here on the operating margin, and as I said at the outset, the run rate operating margin, where we were in terms of the margin at the end of the period compared to the start of the period, which is a more useful metric of the, if you like, the current status of the business. So we would expect this 31% or so operating margin to be moving back to the mid to high 30s as the business scales. We were at the high 30s a year ago, but that was because we hadn't really caught up with the costs required to manage what had been a very sharp increase in total business. Cash position remains very strong. We do have an annual cycle of cash, which is peaking towards the end of the year before we pay bonuses and dividends. Capital adequacy has got very strong buffers, so we are a business without debt, nicely nice levels of cash reserves on the balance sheet, and therefore a very resilient business looking at the plan for growth. Shareholder register is nicely stable, so management owns 20% of this business. As I said, BNP Paribas Asset Management, largest shareholder at just less than 14%, and then we've got a nice group of UK small cap type managers who own probably around 30% of the business, and then a nice ownership base with people like yourselves. I believe some of you are already shareholders, and we've got a nice UK following. So I think just wrapping up, the outlook for the company over the next 3 to 5 years is incredibly positive in the context of this transition to a more sustainable economy. The world is experiencing a number of sectoral transformations, industrial revolutions, if you like, around energy, materials, infrastructure, food, and other areas, including healthcare and financials, where technology change, policy change, changing consumer demand are somewhat complex to navigate, and therefore creating lots of price inefficiency, which is giving us as investors a way to beat markets. After quantitative easing, the last 10 years, we're going to be in quite a choppy period, potentially for the rest of the decade, in which central banks are without a playbook for how to rein in this QE. And so in that context, investing passively, in our view, is going to be increasingly challenging. So active management definitely going to have quite a strong audience. So in that context, investing with a particular focus in an inefficiently priced area, we think is a particular strength. And hopefully I've been able to explain in the last 50 minutes or so how we've set up this business to be scalable, and the efforts we're going to ensure that we've got the right distribution outreach around the world and the right focus on metrics to ensure that we're growing efficiently. So I'm going to wrap up there and go back to moderator for questions.
Ian, thank you very much indeed. We've got lots of questions. A few subjects, a few question areas are quite common. So the first, you addressed it towards the end there, the active versus passive debate. And this question kind of sums it up nicely. Can passive funds operate in this area, and are they competition for you? And if not, why not?
So passive portfolios do exist. So there are definitely baskets of stocks, for example, in water or food or renewable energy. However, to produce a basket of stocks, which is a blend across all these themes, is somewhat tricky, not impossible. And therefore, those sort of blended passive baskets are not particularly common. Having said that, it's generally straightforward to beat the passive basket, and so that's obviously part of our objective. Our experience, having spent 25 years talking to clients around the world, is that there does seem to be a sort of self-selection for clients, either to go passive or to go active. And there's no shortage of asset owners who are wanting to find active managers with interesting ways of interpreting the future.
Next question is about water. I think it was about 16%. And the question is, what sort of companies do you end up owning, and does that include utilities?
Yeah, so we have a water fund, which we run for BNP Paribas. But generally, water is one of the components of our thematic funds. So alongside renewable energy and materials and food, etc. So in the water space, we're typically investing in 3 types of company. Firstly, technology businesses, for example, that produce membranes or pumps. Secondly, infrastructure businesses that integrate such technology into engineering solutions that they sell to the third type of company we're investing in, which of course is utilities. So those 3 types of company do behave financially very differently from each other, and so there's an inherent diversification possibility to invest in what does appear on the surface to be quite a narrow idea, but there are three very different types of company in there, which gives you a nice opportunity to build resilient portfolios.
The next question is about the definition of sustainability. Who decides what is sustainable? Is that external, or is that yourselves? And then the kind of second part to that, does that include nuclear?
So good question. So the thematic work that we do is quite robustly defined through an environmental taxonomy, which we drafted or created back in 1999. It's called our environmental markets classification. And essentially it's a list of 27 or so industries which are all producing solutions to environmental problems or improving resource efficiency. So it's a pretty conservative definition. It doesn't include nuclear, not for any ethical reason, but just we didn't feel in 1999 when we created the taxonomy we needed to go there, or frankly that there are that many investment opportunities. So that's the thematic area, which is just over 60% of our revenues. The sustainability lens area doesn't have a rigid definition of sustainability and therefore a sort of gate in or out, but it uses 5 to 10 year trends around these planetary boundaries and resource constraints to point the searchlight for ideas, investment ideas, at certain industries, certain sectors that are likely to expand and succeed in the context of this transition, and discourages us from looking at areas or sectors that are poorly placed in the context of the transition, for example, fossil fuel extraction.
Next question, and one from me actually. You mentioned the Inflation Reduction Act in the States. I don't think it's had really a huge amount of coverage here in the UK. I think the scale of it's actually appreciated, and then maybe a European response. Could you just talk for a moment about what that act is and then the impact of that level of investment and the opportunities that there are for you and your funds?
Yes, so the Inflation Reduction Act is a piece of legislation that was passed a few months ago in the United States. It's a federal act, and it does a number of things. Probably the most straightforward to explain is that in the areas of wind power and solar power, it replaces a stop-go system of tax credits with a 10-year commitment around tax credits. And tax credits are the way that the American economy has been incentivizing investment in certain areas. Europeans have tended to provide incentives through subsidies at the revenue line. The Americans have decided to use tax credits instead. So the Inflation Reduction Act, amongst other things, puts in place a 10-year program rather than the stop-go 18-month, even 12-month programs that were constantly having to go back to Congress. There's also in the Inflation Reduction Act a lot of fiscal support for new technology developments and for manufacturing of certain clean tech-oriented products, for example, batteries for electric vehicles or the assembly of electric vehicles. So from the perspective of an international company, multinational company, looking to establish a factory, for example, in water membrane manufacturing or electric vehicle component supply, then the US is, post the Inflation Reduction Act, dramatically more attractive from a P&L fiscal perspective than it was before the act was passed.
Question about the Tokyo office. Is that to serve the whole Asian market, or is the focus on Japan? And how do they embrace in Asia sustainable investing? Has it developed an idea there as it is in Europe and the US?
We've had an office in Hong Kong since 2007 because we found that there's a large number of listed companies in the Asia Pacific region that are active in our space China dominates the world of solar panel supply, for example, as it does batteries for electric vehicles. And having a Chinese-speaking team in Hong Kong has been incredibly helpful in navigating those sorts of opportunities, not just in China, but throughout the ASEAN region, Japan and Australia. So Hong Kong has been our investment hub in the region for about 15 years. We've set up the office in Tokyo principally to provide more connection and a greater level of service to our existing Japanese client base, which now includes the GPIF pension fund. But we also see that there's great scope to invest in Japanese companies. I think, as people probably are aware, Japan's been a very successful area for equity investment over the last 9 months or so, and we've certainly benefited from having deeper connections into the Tokyo market. So right now, Tokyo office is for Japanese client service and Japanese stock research. Our main Asia hub is Hong Kong, and the prospects in the region continue to grow. We've just added a new portfolio manager to our team out there, and are excited about the opportunity to add more Asian stocks, not just for regional portfolios, but also into an emerging markets portfolio that we're developing.